Good morning. Welcome to Market Monday. Last week we shared some wit and wisdom from Warren Buffett's annual shareholder letter. While we do agree with some of his investing principles and his long-term track record does speak for itself, in the spirit of transparency and balance, here's a look at the 10-year performance against the S&P 500. This isn't the annual performance comparison, but each bar is the performance comparison over the prior 10 years. We can see in the 80s and 90s, he was an all-star. Even in the early 2000s, he was still handily beating the S&P 500 over the prior 10 years.
However, we can see after the global financial crisis, returns have been more or less in line with the S&P 500 index. Why? Well, one reason is since they started acquiring Apple in 2016, it's grown to over 40% of their entire holdings. Apple is also the number one holding in the S&P 500, weighing in at just under 7% of the index. Of course, many other factors at play, but at least in recent history, it appears Mr. Buffett isn't necessarily the superhuman he's often made out to be.
What else? Last week, Fed Chair Powell testified on Capitol Hill, rattling markets due to fears of persistent inflation and more rate hikes. That also sent Treasury rates to their highest levels in over a decade. Here's the 6-month Treasury, over 5% for the first time since 2007. So risk-free rates are high, some savings accounts are much higher than they were, money market accounts are pretty good, some CDs are respectable, and even fixed annuities for certain folks. So yes, cash management is now a thing, and we're having those conversations during reviews and investment committee meetings.
I think there's a word for all those options. Starts with an A, alternatives. As Chad just mentioned, now there are alternatives for cash management. And not just cash management, but alternatives to stocks. The analysts wasted no time putting their spin on the matter. Remember Tina from a couple years ago? There is no alternative. The idea that if you wanted growth or income, you basically had to own stocks. Well, then Goldman Sachs came out with Terra. There are reasonable alternatives. Not to be outdone, Deutsche Bank endorsed Tapas. There are plenty of alternatives. And finally, Inside Investment had to stick their hat in the ring with Tiara. There is a realistic alternative to stocks.
True, there are alternatives, options, things to consider, but doesn't mean those alternatives are always better. Here's the most basic core reason for owning stocks in the first place. Red is purchasing power of the consumer dollar since the 1950s. And blue is the inflation-adjusted price of the S&P 500 stock market, not just the price of the stock market. Remember Warren Buffett's Coca-Cola dividend growing from 70 million to 700 million? So the value can grow, and so can income. Just the magic of time.
But this is a lot harder than it looks. This is literally a lifetime of investing in one chart. So can you imagine how much news or headlines we consume in one day, multiplied across 70 years? That's why we believe really the only approach to long-term wealth preservation, not growth, long-term wealth preservation across decades and purchasing power preservation is through making a choice, a lifelong choice to be allocated to equities. Hopefully, we can help you steward that along and make reasonable allocation decisions to put ourselves in the best possible position to withstand the test of time.
What Matt's saying is, look at this. Here's a return quilt which shows the ranking of 20 different asset classes from best to worst since the mid-80s. For example, it has S&P 500, large value, small value, emerging markets, long treasuries, real estate, and even Bitcoin. As we flash a few asset classes, ask yourself, is there a consistent, reliable pattern? Is one sector or asset class always on top, on bottom, in the middle? This is part of the challenge. We talk about the S&P 500 index pretty much every week here. It's the flagship. It's the index, and plenty reasonable enough to allocate to it, but not always the best, despite a great run over the past 10 to 12 years.
Indeed. And for today, we'll wrap with, after a great start to the year, wasn't that a disappointing February and March? Yes, while we are going to have disappointing Februaries and Marches during our investing lives, it's natural to expect a breather after such a strong start to the year. Have a look. Here, we're looking at the annual stock market performance of, yes, you guessed it, the S&P 500 since 1950. But only those years the S&P 500 was up more than 5% during the month of January, like we had this year. Up strong to start, then quite a long pause all the way through April, only to take off again for the rest of the year. The average return for these full years was 22.9%. Is it guaranteed to happen? Of course not. Could it happen? Clearly yes. Have a great week.